Ladies and gentlemen, if you think you've seen volatility before, forget everything you believe about markets. Because what just happened in the silver market isn't a correction. It isn't a blip. It's not even a crash. This is the biggest liquidity event in financial history. We're witnessing the unraveling of the last remnants of confidence in fiat money right before our eyes. For decades, I've warned you that paper money created out of thin air by central banks can and will fail. But even I didn't imagine the speed, the scale, and the ferocity with which this repricing of money would come. Silver, once dismissed by Wall Street as a niche or speculative play, just lit the fuse on a liquidity event that dwarfs the crashes of 2008, the dot-com bust, and every so-called financial panic you've ever studied. What just happened in the silver market is not a routine correction, not a speculative bubble popping, and not some isolated commodity event that investors can casually dismiss. This was a historic liquidity shock, the kind that exposes the fragility of the entire financial system. And if you're paying attention, you understand that silver didn't cause the problem. It revealed it. Liquidity is something most investors take for granted. They assume there will always be a bid, always a buyer on the other side of the trade. But liquidity is not permanent. It is confidence masquerading as stability. The moment confidence cracks, liquidity vanishes. And that is exactly what we just witnessed. Silver trading volumes exploded, spreads widened, leveraged positions were forced into liquidation, and what was supposed to be a deep global market suddenly looked thin and fragile. This wasn't random. This was the inevitable consequence of years of artificial stimulus, suppressed interest rates, and reckless monetary expansion. When central banks flood the system with cheap money, they encourage speculation, leverage, and complacency. Investors stop pricing risk properly because they believe there will always be a safety net. But when that net starts to tear, the unwinding is violent. Silver sits at the crossroads of monetary, metal, and industrial commodity. It's sensitive to inflation expectations, currency weakness, and economic growth all at once. So when silver experiences a liquidity shock of this magnitude, it's not just about supply and demand in one market. It's about stress radiating through currencies, bonds, and credit markets globally. What made this event historic wasn't simply the price movement. It was the speed and the forced nature of it. Margin calls cascaded. Funds that were over-leveraged were compelled to dump positions. Market makers widened spreads or stepped back entirely. And suddenly, what looked like a calm and orderly market turned chaotic. That is the hallmark of a liquidity event. Not gradual repricing, but abrupt dislocation. And here's the uncomfortable truth. Markets built on leverage are always vulnerable to liquidity shocks. The more debt embedded in the system, the more fragile the structure becomes. Silver just happened to be the pressure point where the fracture showed first. But make no mistake, the underlying issue isn't silver, it's systemic overextension. For years, policymakers have relied on monetary expansion to solve structural problems. Instead of allowing markets to clear excesses, they postponed adjustments. Instead of encouraging savings and productivity, they encouraged borrowing and speculation. The result is an economy dependent on constant liquidity injections. Remove even a fraction of that perceived support and instability surfaces immediately. The disconnect between paper contracts and physical demand also became glaring during this event. When volatility spikes and confidence erodes, investors don't want exposure through layers of derivatives and counterparty risk. They want tangible ownership. That divergence puts enormous strain on the financial instruments that dominate trading volume. When too many participants attempt to convert paper claims into real assets at once, the system struggles to accommodate it. This liquidity shock is a warning. It tells us that markets are more fragile than headlines suggest. It tells us that leverage is still excessive, and it tells us that the illusion of stability created by years of easy money can dissolve in a matter of hours. The bigger concern is contagion. Liquidity events rarely stay contained. When traders are forced to raise cash, they sell what they can, not just what they want to. That selling pressure spreads to unrelated assets. Correlations rise, volatility increases, and what began as a silver dislocation can quickly morph into broader financial stress. If you think this was an anomaly, think again. This is what happens when a financial system becomes dependent on perpetual intervention. It functions smoothly only as long as confidence remains intact. Once that confidence wavers, liquidity evaporates, leverage unwinds, and prices adjust far more violently than anyone expects. Silver didn't break the system. It exposed the fault lines that were already there. And when a liquidity shock of this scale erupts in a market so closely tied to monetary psychology, it's not just a market story. It's a signal that the era of effortless liquidity may be ending, and that the real repricing of risk has only just begun. For decades, the United States has enjoyed what many assumed was an unshakable privilege, issuing the world's reserve currency. That privilege allowed Washington to spend beyond its means, run chronic deficits, and accumulate mountains of debt without facing the immediate consequences that any ordinary nation would endure. But privilege is not immunity, and what we are witnessing now is the slow but undeniable exposure of the dollar's fragility driven by relentless monetary debasement. Let's be clear about what debasement really means. It's not some abstract academic concept. It is the deliberate expansion of the money supply that erodes its purchasing power over time. When more dollars are created without a corresponding increase in real productivity, each existing dollar buys less. That loss doesn't happen all at once. It creeps in gradually masked by official statistics and optimistic forecasts. But the damage compounds. Central banks don't frame it this way. They talk about stimulus, liquidity support, and stabilization, but printing money, whether digitally or physically, does not create wealth. It redistributes it. It shifts purchasing power from savers and wage earners to debtors and asset holders. It rewards speculation and punishes prudence. And the longer this continues, the more distorted the economic structure becomes. The dollar's global dominance has masked these distortions. For years, foreign governments and institutions have absorbed U.S. debt, recycling trade surpluses into treasury bonds. That external demand created the illusion that deficits didn't matter. But demand for a currency is ultimately rooted in confidence. Confidence in fiscal discipline, confidence in monetary restraint, confidence in long-term stability when deficits explode year after year, when entitlement obligations expand without funding, and when interest costs begin consuming a growing share of tax revenue, confidence starts to erode. And once the world begins to question whether the United States can manage its finances responsibly, the dollar's position becomes far less secure. Interest rates are the clearest signal of this fragility. Artificially suppressing rates through monetary policy creates temporary relief for borrowers, particularly the government. But it also distorts capital allocation. It encourages excessive leverage and discourages saving. When rates inevitably rise, either due to inflation pressures or declining foreign demand for debt, the burden becomes heavier. Higher rates mean higher servicing. Higher servicing costs mean larger deficits. Larger deficits require more borrowing or more money creation. It becomes a vicious cycle. The fragility of the dollar is not just about exchange rates. It's about purchasing power at home. When everyday essentials become more expensive, when wages struggle to keep pace with rising costs, people feel the erosion directly. Inflation is not just a statistic. It is a tax. A silent tax that doesn't require legislation because it operates through the currency itself. And once inflation expectations become embedded, reversing them is extraordinarily difficult. Central banks can talk tough, but tightening policy in a heavily indebted economy carries enormous consequences. Asset prices fall, credit markets strain, growth slows, policymakers face immense pressure to reverse course. That hesitation undermines credibility. And credibility is the backbone of any fiat currency. What makes the current situation particularly dangerous is the scale of the relative to the economy. The higher the debt load, the less tolerance there is for higher interest rates. That creates an incentive to tolerate inflation rather than confront it. Gradual currency erosion becomes the path of least resistance. But gradual erosion compounded over time becomes substantial loss. The dollar's strength in the past was supported not just by military and economic power, but by trust. Trust that obligations would be honored in money that retained value. Trust that fiscal discipline would ultimately prevail. If that trust weakens, alternatives emerge. Diversification away from the dollar accelerates, demand softens, and the cost of financing deficits rises. Monetary debasement is not dramatic in a single moment. It is cumulative. It's a policy choice repeated year after year, and the fragility of the dollar is the natural outcome of those choices. You cannot expand the money supply indefinitely, run perpetual deficits, and expect purchasing power to remain intact. The warning signs are visible for those willing to look. The question is not whether debasement has occurred. The real question is how much further it will go before confidence reaches a tipping point. Because once confidence in a currency breaks decisively, restoring it is far more difficult than preserving it would have been in the first place. One of the most revealing aspects of this entire episode has been the widening gap between the paper market and physical reality. For years, investors were told that a futures contract, an ETF share, or a derivative exposure was just as good as owning the metal itself. Convenient, liquid, efficient. That was the sales pitch. But what we just witnessed shattered that illusion. Because when stress hits the system, paper promises don't behave the same way as tangible assets. The paper market is built on leverage and confidence. Contracts trade hands in enormous volumes, often representing many multiples of the actual physical supply available. Most participants never intend to take delivery. They speculate on price movements, roll contracts forward, and rely on counterparties to honor obligations. It works smoothly until it doesn't. When volatility spikes and liquidity tightens, the structure shows its weakness. Paper holders rush exit positions. Margin calls cascade. Market makers widen spreads or step aside entirely. Prices swing violently, not necessarily because of changes in underlying supply and demand, but because of forced selling and leveraged unwinds. The paper price becomes a reflection of financial stress rather than physical scarcity. At the same time, something very different happens in the real world. Dealers report surging demand. Inventories tighten, premiums rise, delivery times extend. The physical market responds to fear and uncertainty, not with panic selling, but with hoarding and accumulation. People don't want exposure through a brokerage statement. They want direct ownership. That divergence, collapsing paper prices alongside rising physical premiums, exposes the structural imbalance. This isn't a minor technical glitch. It's the natural consequence of a system that has prioritized financial engineering over tangible value. The volume of paper claims can expand almost infinitely because creating a derivative requires little more than counterparties willing to sign contracts. But physical supply cannot be conjured with a keystroke. It must be mined, refined, transported, and stored. That constraint matters when confidence erodes. For years, the dominance of paper trading suppressed volatility and gave the impression of deep liquidity. But that liquidity was conditional. It depended on participants believing that delivery would never be demanded in mass. It depended on leverage remaining manageable. Once those assumptions are challenged, the imbalance becomes obvious. The dislocation also reveals something deeper about modern markets. Price discovery has been largely financialized. When the majority of trading volume occurs in leveraged instruments rather than physical exchange, the quoted price can detach from underlying fundamentals. That detachment works in both directions. It can suppress prices during calm periods and exaggerate moves during stress. When investors recognize that their exposure is merely a claim dependent on clearinghouses, counterparties, and settlement mechanisms, they reassess risk. Counterparty risk, once ignored, suddenly becomes settlements risk, storage risk, systemic risk. All of it resurfaces. And when too many participants attempt to convert paper claims into physical assets simultaneously, the system strains under the weight. This dynamic is not limited to one market. It's a broader reflection of how financialization has reshaped asset ownership. We live in a world where layers of abstraction separate investors from the underlying asset. That abstraction works efficiently in stable conditions, but during stress, simplicity regains value. Direct ownership eliminates layers of dependency. The widening spread between paper pricing and physical premiums is a signal. It tells us that confidence in financial intermediation is weakening. It tells us that investors are questioning whether synthetic exposure truly substitutes for tangible assets. And it tells us that leverage amplifies fragility. Ultimately, markets function on trust. Trust that contracts will be honored. Trust that settlement will occur smoothly. Trust that liquidity will be present when needed. When that trust falters, the distinction between paper and physical becomes impossible to ignore. Paper is only as strong as the system backing it. Physical ownership stands independent of that structure. This dislocation is a reminder that financial innovation cannot eliminate economic reality. You can multiply claims, you can expand derivatives, you can create layers of synthetic exposure, but you cannot replicate scarcity. And when scarcity collides with leverage, reality reasserts itself. The paper market may dictate headlines, but in moments of stress, the physical market reveals the truth. What we are witnessing is not an isolated disturbance confined to one corner of the market. It is a broader signal of systemic stress, a warning flare rising above a financial structure that has been stretched, leveraged, and artificially supported for far too long. When pressure builds beneath the surface, it rarely announces itself politely. It erupts where the structure is weakest, and once it does, the tremors travel outward. Modern financial markets are deeply interconnected. Banks, hedge funds, pension funds, sovereign institutions, they are all tied together through layers of credit, derivatives, and cross-collateralized positions. That interconnectedness creates the illusion of stability during calm periods. Risk appear diversified. Exposure seems hedged, but in reality, it creates channels through which stress can spread with astonishing speed. Systemic stress doesn't begin with headlines. It begins with tightening liquidity, rising volatility, and subtle shifts in funding conditions. It begins when lenders become slightly more cautious, when counterparties demand slightly more collateral, when spreads widen just enough to make refinancing more expensive. Those small shifts multiplied across a highly leveraged system compound rapidly. Debt is the common denominator. Over the past several decades, debt levels have grown faster than underlying productivity. Governments borrowed to fund deficits. Corporations borrowed to finance buybacks and acquisitions. Consumers borrowed to maintain lifestyles in the face of stagnant real wages. Cheap money made it all seem manageable. Low interest rates reduced the apparent cost. But low rates do not eliminate risk. They disguise it when rates rise or liquidity tightens. The burden becomes visible. Servicing costs increase. Margins compress. Highly leveraged entities face refinancing risk. What once looked sustainable under near zero rates becomes precarious under normalization. And because so many balance sheets are extended simultaneously, stress emerges across multiple sectors at once. Another sign of systemic strain is the breakdown of traditional correlations. Assets that once moved independently begin to move together. In moments of stress, investors sell what they can, not just what they want to. That means high-quality assets can decline alongside speculative ones. Correlations converge toward one, a classic feature of liquidity-driven sell-offs. Financial institutions themselves become cautious. Interbank lending can slow. Risk models adjust upward. Capital buffers are reassessed. None of this necessarily triggers immediate collapse, but it signals that confidence is eroding, and confidence is the oxygen of the financial system. Without it, credit contracts. What makes the current environment particularly vulnerable is the reliance on policy intervention as a backstop. Markets have grown accustomed to the idea that central banks will intervene whenever volatility spikes or asset prices fall too sharply. That expectation encourages risk-taking during expansions, but it also creates a dangerous dependency. If inflation pressures limit the ability of policymakers to provide immediate relief, markets must confront risk without the safety net they assumed was permanent. Systemic stress also reveals structural imbalances that were previously ignored. Asset valuations that depended on ultra-low discount rates must be recalibrated. Business models relying on cheap financing must adjust. Governments facing rising interest costs must make difficult fiscal choices. These adjustments are not smooth or painless. They involve repricing risk across the board. The global dimension adds another layer of complexity. Currency fluctuations, capital flows, and sovereign debt dynamics amplify stress across borders. What begins in one market can rapidly influence others through trade linkages and financial exposures. Contagion is not a theory. It is a recurring feature of highly integrated systems. Importantly, systemic stress does not require a single catastrophic event. It can build gradually, punctuated by sharp episodes that reveal underlying fragility. Each episode chips away at confidence. Each dislocation forces reassessment over time. The cumulative effect can reshape investor behavior and capital allocation. The broader message is clear. A financial system sustained by leverage and continuous liquidity injections is inherently sensitive to shocks, remove, or even reduce that support, and vulnerabilities surface quickly. This is not about pessimism. It is about recognizing structural realities. When debt levels are elevated, when asset prices are extended, and when confidence is heavily reliant on policy intervention, stress becomes inevitable. What we are seeing is not random volatility. It is the manifestation of imbalances that have been building for years. And when systemic stress reveals itself, it serves as both warning and inflection point. A reminder that financial stability built on leverage and perpetual intervention is far less durable than it appears. Let this be your wake-up call. This event is not a headline. It's a historical turning point. The days of believing that paper promises are equivalent to real value are over. The lesson is brutal, but it's clear. Money that can be printed eventually gets repriced. And the repricing always favors sound money over fiat illusions. If you were asleep, consider yourself awakened. If you were skeptical, consider yourself vindicated, because What just unfolded in the silver market is not just a market event. It's a revelation of truth about money, debt, and the fate of Western finance. And with that, prepare yourselves because this is far from the end. It's just the beginning.